So we have Paul Neal with us here today. Paul, I appreciate you being with me here as we cover a pretty timely topic as we talk about how to position yourself in this pending recession. But before I do, I want to direct everybody to Paul's website. So head over to vpc.capital/podcast-rei. And there's no .com in there, everyone. So I'm going to make sure to have that link in the show notes. So it's an easy clickable link for everybody, Paul. But I appreciate you being with me here today as we tackle this timely conversation.
Yeah. Hey, Jack, I'm really excited to be here. Super excited. I appreciate the invite. And I certainly working with so many entrepreneurs and investors. I get these questions all the time. So I'm excited to dive in here with you today.
So let's talk briefly about your core business, though, so everybody knows, because if they go to your website, I mean, you're even offering a 20-minute discovery call with some people. What does you and your team do?
So our core business is funding. So we help entrepreneurs and business owners fund the growth of their businesses and really ultimately their dreams. And, I've been an entrepreneur ever since college. That I don't want to date myself, but back in the late 80s, have owned a string of businesses. Some have worked out really well. Some have blown up in smoke. And so it's been a passion of mine to really come alongside as a partner for entrepreneurs to help them, achieve the goals and dreams they have. So we provide funding. We're really in three main areas. Commercial real estate, including, owner occupied, sort of buying your own building, but also investment real estate, business acquisitions, which we see a lot with entrepreneurs and business owners. And ironically, a lot of real estate investors are also successful business owners, and, they have extra cash and, they're wanting to build their wealth and diversify. And the third area is growth capital. So those are sort of the three areas. They're kind of large buckets, but we find that a holistic approach to the entrepreneur really allows us to provide comprehensive solutions to both their short and long-term needs. And so we like to partner up with them, and we're not transactional. We're more strategic and partnership oriented.
So were you involved in this type of funding business when the 2007, 2008, 2009, when we saw that last dip in the economy?
Yeah, sort of. Yeah. I was more in the residential space. I had a residential mortgage company. In fact, we were sort of on the cusp of selling it. It was doing quite well. And the world crashed overnight. As you know, liquidity went to zero and literally overnight. And so yeah, in a related industry, we didn't do much commercial, although I was involved in commercial at that point, more as a consumer of it from owning lots of corporate debt and large lines of credit and that sort of thing. And that's one reason, I guess, my education came the hard way through the School of Hard Knocks in that space, and realized that folks like me needed alternatives to the traditional bank and sort of somebody in their corner that understood, what it was like to have to make a payroll and, the ups and downs and the good, the bad, and the ugly.
Sure. So what do you see here now? Are you seeing any kind of similar signs in the market? I mean, we definitely just got word. We got 2 quarters now of negative results. So it looks like we are on the cusp if we're not in a recession already.
Yeah, that's true. That's one of the marks, two consecutive quarters of negative GDP growth. Another one that we really look at is when the unemployment numbers start to turn up pretty significantly. If you look at the past, 6 or 7 recessions that we've been through, there's always one of the coincidental factors is, you go from a point of low unemployment to it starts turning up. And it does make sense, because if, you're an entrepreneur or you're a business owner and you've got maybe, a few employees perhaps on the periphery that aren't as productive as you think they should be, or maybe your new orders aren't coming in as strongly as you would like, or maybe they have in the past, then you're going to take defensive moves. And one of those is to start cutting staff. And so really, those are the two indicators. We haven't seen any market turns up right now in unemployment, but we are starting to see a small trend in that direction. So, I mean, I think we're definitely heading that way. Whether we're in it right now or not is a little bit, sort of up for academic debate. But I think in either case, people are feeling a definite change in the marketplace.
So do you find that there's a little volatility regarding that number, the unemployment rate, just because we just kind of came out of all these lockdowns and a few other things, and people are, I would have to think we're kind of back into the swing of things when it comes to employment, but it seems like there's still a lot of employees wanted signs all over the place.
Yeah, it's a really kind of an odd place, that we are with that. You're right. We came out of the lockdown, we moved to a hybrid workforce. Nobody wanted to, go into the office anymore for obvious reasons. And then I think for more lifestyle reasons after that, you have a group of baby boomers that, that were on the cusp of retirement that decided to take the opportunity to retire. So we lost a whole segment of the workforce there. You had a lot of working moms that decided that maybe they didn't want to go back into the workforce because they could work flexibly from home. Just a lot of currents there. So not really sure. I mean, I don't know that we have the clear answer. I think it might be in hindsight, what that's going to look like. But I do believe that if we are moving into a recessionary period, that the cream will rise to the top. And, there's been a lot of pressure on wages and that sort of thing for employees to demand more pay. In a recessionary period, employers are going to sort of demand more productivity and they're going to look for the best. And, one of the positives that's come out of this whole COVID thing is that now, where many businesses were focused locally with technology and whatnot, we realize we can recruit and hire and train people, with really no geographical limits. Mm-hmm. So it's an interesting time we're in there.
Yeah. So let's talk about some of your recommendations then. How do we as entrepreneurs and real estate investors, or frankly, possibly just employees, how do we position ourselves in the best possible way for this impending recession?
Well, I think there's some key things that we can all do, moving into this period. I think one of the things that we need to understand is that it will be temporary. These things don't last forever, and tremendous amounts of profit have been made during recessionary periods of time. So there's always opportunity, like for instance, on the housing market, on the residential side, rates sort of went from 2.5% to 6.5% in 6 months. But when the Fed started raising the interest rate, the prime rate back in June, and then again 2 days ago, yesterday, I believe, actually, that signaled to the bond market that, hey, we're going to try to get a handle on this inflation. And so mortgage rates have started to come back down. The 10-year bond, which a lot of the rates are loosely sort of related to, has come down from a peak of 3.5 down to 2.67. So I think there, in the recession, there's going to be opportunity in a lot of areas. The housing market, I think, is going to present one. But I think the three big takeaways as I reflect in the past and think about myself and a lot of the clients that we work with is, the first thing I would say would be to attack your expenses, 80-20 those things. I'm a big fan of Pareto's principle, the small hinge, that turns the big door. What few things can we do to make the biggest impact? And, a couple things come to mind there. One is, review all of our credit card statements and bank statements for these auto drafts and auto charges. I think I had a friend tell me one time, and I thought it was great that his CPA required him to defend literally every quarter. He had to defend every credit card charge to say, yes, I need this. This is not a luxury. This is a necessity. I've got to have it. And of course, luxuries are fine if you can afford them, but moving into, a recessionary period, it might not be the best choice, but at least be aware of it. How many times do we have charges come into our credit card or our debit cards that just, we don't even know about? They just hit us, particularly, entrepreneurs. I don't know if you've got this, Jack, but the shiny bouncy ball syndrome, and hey, I love technology and let me try, let me try this or let me try that. And, and I think it's great to experiment, but how many of those experiments fall on they fall on the ash heap of history, but yet we're still paying for those.
Right.
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 So I think you ruthlessly go after those with a highlighter and start attacking them. I hate to say it, but, from a staffing standpoint, if you run a business, really be, not ruthless is not the word, but be cognizant, take inventory of the positions that you have and relook at that organization chart to see, are we doing what we need to be doing? Do we have extra employment here that maybe we don't need right now, or maybe for the next 12 to 18 months? And I know that sounds crazy because it's been so hard to hire people in the last 2 years. But I think with that, there's also sort of been an attitude that's developed with a lot of people that, they can sort of, call their own shots and from an employee standpoint. So I would look at that. And, from a real estate investing standpoint, maybe review the management company fees, look, and some of the subs and the different, different companies that you're utilizing to make sure you're getting the best deal, maybe renegotiate some of those. Here's an interesting one in terms of 80-20 your expenses. How about buying out a partner if you have a business? Maybe this is an opportunity that, hey, your partner has been around for a little while and maybe that partner wants to move on to greener pastures. Maybe they're a little older. We see a lot of that and they don't want to really kind of knuckle down through the recession. Maybe this is an opportunity to review something like that. So I would say the first big thing is really just dig into the expenses. I mean, I think the second thing is to shore up the balance sheet, look at your debt, obviously the conventional wisdom is to pay off any really high interest debt. But I would also say right now I'd be careful doing that because cash is going to be king. It's always king in a recessionary period. So what I might consider more would be, if you have, business debt, and I'm really specifically talking about business debt, but it applies to personal as well. Can you extend the terms? Can you renegotiate those? Can you consolidate some things? A lot of business debts are on short terms and there are ways to push that out just to improve cash flow. And maybe there's something on your balance sheet, there's an asset you have that you don't need anymore. You're not using a piece of equipment or for that matter, a piece of real estate that is not performing the way you want it to. Maybe you sell and look to, get that off your balance sheet and again, preserve some cash. Which brings me really to my third point, and that is really cash. Warren Buffett said, be fearful when others are greedy and greedy when others are fearful. So, we're kind of at a time right now where I think there's great opportunity. But again, those that have cash are the ones that are, going to be able to take care, jump on the opportunities when they present themselves. There are ways to do that, maybe secure a line of credit. One of the things that I love to do if you're a business is to really dial in your accounts receivable. I see this all the time, and I've had this with some of my companies in the past where we were kind of lackadaisical or laissez-faire about really, any kind of collections. And this might have to do with, renters as well, but more for entrepreneurs. We got aggressive in asking for deposits up front, following up. Just basically, we hired a gal at one point just to get on the phone and remind customers about 2 weeks before their bills were due that they were coming due to pay. And that really helped, believe it or not. So it shortened the cash cycle for us. So we had more in the bank. There are ways to there's a concept called factoring where you can essentially turn your invoices into money up front. That's an option for some people, but not all. But again, with the cash and those opportunities, be looking for that now during the recession. Again, while other people are fearful. Again, business acquisitions. Can you expand your business? Can you in real estate, or some people getting knock-kneed and they're like, I'm not sure I want to hold on to this property. Now's the opportunity to be looking for those. Maybe it's a good time to buy your building if you have a practice, a business of some type. Maybe you're a successful dentist. We have one right now is building a building in Austin, Texas. And he's a real estate investor, and he decided he wanted to add his own building for his practice into that portfolio. And so he's building the building where he's going to lease out a little under half of it. And that's going to pay a significant portion of his of the rent he's already paying to somebody else. So I would say those are the big three at this point that I've identified, is just really aggressively look at your expenses, shore up that balance sheet, and really, start stockpiling cash and looking for opportunities.
Mm-hmm. Now, those are some great points. You bring up check your personal expenses. One thing it just kind of reminds me of a quick little anecdote here is that I got a new debit card with a new debit number because mine expired or something. And I didn't renew Netflix. And I have a family of 4 here, and it's been months now, and not a single person has mentioned that Netflix doesn't work. It's amazing, like what you're paying for that frankly is just not being used.
It really is. And, I'm as guilty about this as anyone. And that's probably why I brought it up. Periodically I think about it. And, I did make myself a rule many years ago that as I was going after the bouncy ball and trying some, the latest and greatest software that was going to revolutionize my life and my business, and, in 3 easy payments, they always wanted an annual contract, right? And they would really, in some cases, twist your arm. And I just would never, ever do that. And I felt like, well, if it's so good, then, I don't need an annual contract. And if it's so good, then, I'd be happy to pay every month. And most times that served me, because I found out that my appetite and desire to go pursue something wasn't going to be met with the golden ticket. And so I was able to cancel it. But even still, I'd end up paying 2 or 3 extra months and hit myself on the head. And I'm like, why am I paying $160 a month, which is, that's real money, right? For something that is just worthless. So to me.
Great. And then you also mentioned, you're absolutely right. I think there were more millionaires created coming out of the last recession than any time in history. And it is going to happen again. They'll probably break that record coming out of this one. Yeah,
I think so. And, I think the housing market's interesting. I know a lot of your listeners are real estate investors and single family. And we focus mostly in single family up to about 30 units or so is kind of where we play. And the inventory situation, I know everyone's been, talking about that, and we do expect it to come up some, but, I saw a Black Knight statistic a couple of weeks ago. It was in the neighborhood, I'm paraphrasing, but about 40% of all mortgages on the books right now are less than 3 or 3.5% interest rate. And, 45% of the homes are free and clear in the market. And so you have this whole sector of the housing industry that those people aren't going to move, right? Mm-hmm. Why would you leave your home and your 3.5% mortgage and go buy a new home at a 5 or 5.5% mortgage? And not to mention the fact that the price on the home has gone up, significantly in the last 2 or 3 years. So I get to pay 50% or 100% more for a home and pay a higher interest rate. Makes no sense. So those people are only going to move if they have to move. And so even with rates coming up and now starting to moderate, which again, in a recessionary period, historically, you'll see that interest rates have always moderated in the long end of the curve. So with inventory stabilizing and getting more into a sort of a balanced market, but not an overglut of inventory, I think it's going to present great opportunities for those people that are staying in the game and not running with their tails tucked between their legs. I mean, I think we need to be smart, and we need to be, be very cognizant about what we're walking into and make sure the deals make sense. But I think we also need to maybe turn the media off a little bit. And, they're hyperbole on everything, right? Everything is a crisis du jour. And the housing market is just great for crisis, and recession is just great for crisis, because if it bleeds, it leads. And that's how we sell tickets. And so I think if you're serious about your future as an entrepreneur or an investor, I think you need to turn that off. There was a period in my life, I'll tell you, my wife and I were young and we had been in business not long. We literally took our TV out to the dumpster. That's when you used to have the TVs that were, with a tube in them, and they were kind of heavy. Now, granted, it was a small TV. We didn't have a lot of money back there in the early days, but still, we took it out and literally threw it in the dumpster. And we're like, we don't have time for this in our life. And it was probably the best decision. In fact, I think about it today, and I think maybe I should do the same thing. Maybe I should take my TV out of the house, a couple of TVs, and get rid of them. But yeah, I think it's going to be a great time, an opportunity for those people that are looking for it.
Sure. So as you're preparing for this, how is your underwriting and things changing? Have they at all?
Yeah, they have. They have. We see, we're being defensive too. And so in the past, where on the loan to value side, we would go a little higher we'll just take single family investments, for instance, we would go all the way to 85%. We've trimmed that back to 80 in most cases, but we'll still good cash out to 75% in many cases. We're being a little cognizant, like, for instance, in terms of concentrations and things. One of our clients is a builder, and they build about 6 to 8 homes a month. And they just recently came in, and they wanted to build in a few homes in an area that we felt like they're getting a little heavily concentrated in. And so we're having some conversation with them. We may cut back a little bit on the loan to value. But again, I think a lot of that is a bit of a knee jerk. People are kind of in the wings waiting to see what's going to happen, in a sense that rates went all the way up and peaked into June with the inflation fears. And we're still going to see inflation numbers for the next couple of months because we're looking at a 12-month moving average. And when you look at the 12 months ago, the numbers were low, the reported numbers were low. And so the difference today is going to show high. When we start getting into September, October, the numbers from September, October a year ago were higher. And so the delta is going to look smaller, and it's going to look like those numbers are coming down. So plus, you're seeing other signs like the Walmarts and Target recently came out and said they're carrying a lot of inventory. So they're going to be cutting prices. So I think the knee jerk, particularly in the investor market, was, hey, we're going to cut back on loan to values. We're going to be careful on how much concentration any one particular borrower has, and we're going to look a little bit more at their experience, and we're going to raise the rates because it's a reflective of risk. I think you're going to see that start to moderate once they see where the world goes in the fall. If we don't go through another great recession of 2008, which I seriously don't think we're going to do, then I think you're going to see that moderate, and they're going to get more aggressive and that sort of thing.
Sure. Well, just a reminder, everybody, head over to vpc.capital/podcast-REI. And like I said, I'll make sure to have that link in the show notes. But, well, Paul, I warned us that we're probably going to chew up through our time pretty quickly here, but I do have a few rapid fire questions for you if you're game.
Hey, let's play. Is there a reward here if I get them right?
There's no wrong answer. Let's put it that way.
Okay.
So, well, I mentioned you're on a real estate investing podcast. So what real estate investing myth would you like to bust here today?
That you have to repair the toilet yourself at 8:00 on a Sunday night when the Super Bowl is just getting ready to kick off.
Right.
That's the way I used to think. And funny enough, my father, who I love dearly, had a terrible experience in real estate investing when he was younger, and that clouded my judgment for many, many years. He went into a multiplex, and it was in a bad area. It was just a bad decision, and he will acknowledge that. And it was just kind of funny. But all my life, I was taught that's what you have to do because that was the experience that he had, and it's just not true. And to prove it, my brother went out, and he has a whole portfolio of 17 or 18 single families now. And you just don't have to do that.
Yeah. And it did happen to me once, but it's a story for another time. So you're not able to say Rich Dad, Poor Dad, but what book would you recommend everybody check out, or what are you reading right now?
Wow. I'm reading a book right now called The End of the World is Just the Beginning. And it's actually very interesting. It's a little nerdy, but it talks about how globalization has essentially ended and how we as the United States and North America are actually in a very strong position going forward as things change. Where we went in the 80s and 90s into this whole globalization and supply chain. We saw with COVID how the pandemic disrupted all the supply chains. But how we're blessed here in the United States with with all of our natural borders and inland waterways and technology and people and farmland and all kinds of blessings that most people in the world don't have under one geographic border. And it's a fascinating book. Fascinating. I don't recall the author's name off the top, but it's a great, it just literally came out 2 or 3 weeks ago.
Sure. Okay. Yeah. Based on that title, it was either going to be a business book or some dystopian sci-fi novel. So what is the best piece of business advice you ever received?
Best piece of business advice. Get a coach or a mentor. The best laid plans go awry, and we all get emotionally wrapped into what we do, and we get busy working in our business, and we lose the forest for the trees. And by having a coach or a mentor or somebody who not only knows us and our tendencies, but knows the landscape, and they don't even have to be necessarily an expert in that particular business, but someone who can really hold you accountable to those goals and dreams and targets that you lay out, and really to kick you in the butt when you get off track and stay straight. I mean, if Tiger Woods can have a golf swing coach, I think I can have a coach in business.
Sure. What's the worst piece of advice you've ever received?
The worst piece of business advice. Let's see. That is a good question.
And if you don't have one, that's
nothing comes to mind there. I'm sure it will when we hang up.
that's perfectly okay. So this was a great conversation, Paul. I really appreciate it. One more time, vpc.capital/podcast-REI. Like I said, I'll have that link in the show notes, but is there a question or concept you wished we would have covered here today, Paul?
No, I think Jack, really I really appreciate you having me on. This has been a lot of fun. I think, for me, it all comes down to the why. Why do we do what we do? And as real estate investors, as entrepreneurs, as business owners, we have a goal, a dream, and a mission. And, I just feel like when the entrepreneur builds a successful business, not only do they win, but their family win, the communities win, and ultimately, their employees win, the nation wins. The entrepreneurs is the backbone of this country. And, we're in a fight, whether we realize it or not, with, everything big. I call it, we fight big, right? We fight big government, big tech, big banks in a lot of cases really aren't your friend. Big media, big business. I mean, we found out it was glaringly in our face in the last couple of years, but they all want to consolidate the power of the individual up into the masses. And it's a lot easier to control. They're not in this for you and I, for entrepreneurs. They really aren't in it for our success. They want us to fly sort of in formation, the way that they dictate. And I think that, and that's the other reason I'm just so impassioned by, wanting to help entrepreneurs, because we have a lot of commonality. We're going to come in all races, religions, backgrounds. I always laugh about, everyone's a racist and everyone's this and that. It's like, no, we're the human race. We're more alike than we are apart. And if you're in business and entrepreneurship, then you're really living, right? You've got highs and lows, and it's a fight every day. And so I think that's it. I think just to say, hey, I just encourage all your listeners that you can do it, whatever you're doing, stay the course, and it will be worth it.
Well, I appreciate that, Paul. And I hope we can chat again sometime. This was a great conversation.
Yeah, Jack, it's been great. I hope so too.